Welcome to Unfiltered Finance. I'm your host, Emily Turner, and joining us today is Nathan Tucci, and we are talking about, what could be a 23-5 trading day. So when it comes to this, all bets have been placed on like this 9 to 5 schedule, and that could be out the door. What is the reality of this?
It's almost hard to exaggerate the reality of this, of the 9:30 to 4 p.m. current market structure. I mean, everything we think about, you even gave a couple examples when we were talking earlier, but everything we think about is based on that clock. We think about things like the opening bell and what that means. And we think about things like amateurs trade the open and pros trade the close, like all these cliches that have some truth into them. Almost all of them have some basis in the framework of how the market works, which is a 9:30 a.m. opening bell and a 4 p.m. closing bell. Now, there has been an evolution over the years where you've had some post-market trading, some pre-market trading, et cetera, et cetera. But this is really blowing it wide open. This is a substantial change, not just to, the way the market works and how we experience the market, but really all of the frameworks and strategies and everything that we based over the last 100 years from fundamentally how the market has traded in that time. So I think it's going to be a fascinating evolution that we're continuing here. And I personally believe it has really positive potential implications for regular at-home retail traders.
Yeah, and we're going to get into all of that. We'll talk about actionable items that traders can use to prepare for that. But for folks who may not even really understand what we're talking about, in plain terms, what is a 23-5? What does that actually mean?
Yeah. So for most people, when they think of when the stock market is open, they think of Monday through Friday, 9:30 a.m. to 4 p.m. Eastern Standard Time. Now, a lot of people already understand that's only true in, the actual structure of the exchanges. In reality, there's trading happening before that, there's trading happening after that, there's international markets, but it still is incredibly important that those times dictate the vast majority of trading, and they also dictate much of what's even allowed to be traded. For example, I can buy some underlying stock at 7 a.m. or at 6 p.m., but I can't buy a call option on Apple outside of that window. So there's still a vast majority of trading that is reduced to what we all think of as when the stock market is open. And so the 23/5 would say, actually, the stock market is now going to be open from like 9 p.m. until 8 p.m. the next day. It's going to be a 23-hour cycle with just this 1 hour kind of maintenance, auction bids getting closed up, zero DTE options expiring and being refreshed. All that kind of stuff is just going to happen in this one small window. And really, your opening and closing bell are going to be 1 hour apart with 23 hours of regular trading in between Monday through Friday using those Eastern Standard Time. So it really is a dramatically different setup for anyone trading, and anyone who says, oh, well, it's just the same thing, but it's kind of spread out. I think they're really underestimating how drastically this is going to impact the entire stock market.
Who's pushing for this? Where's it coming from?
Well, there's two kind of sides to this coin. So for a long time, retail traders have pushed for more access, more capability, and I don't think that they have a lot of say, right? So it's kind of funny because we've had this very interesting dynamic where for decades, regular at-home retail traders have wanted things that they've been locked out of. Part of that is pre-market trading, post-market trading, international, certain over-the-counter tickers, all these different kind of things, day trading restriction rules, et cetera, et cetera. And just recently, it seems like the people, whoever those people are, Wall Street insiders and lobbyists and all those people, have actually aligned those interests and thought, you know what? When these retail folks get what they want, there's a lot more money, there's a lot more transactions going on. There's a lot more ways for us to, kind of solidify the market. Institutionally, liquidity is a lot more even when, the market's more open. And so they've just happened to align over the last couple of years, seemingly. And so I think if the question is who's pushing for it, well, probably most people, kind of everyone. But who's actually making it happen? I think it is the people who have the most institutional leverage at the market maker, at the broker level, and then those that they impact on the legislative side, lobbyists and so on, who can actually push through and make these things happen. Because we've gone from very few changes in kind of the structure and the type of things that become open to the public, let's say, over the last 50 years. I mean, we got weekly options and a couple other things to like zero DT options, post market trading through 4:15 p.m. to day trading roll to now 24, like all in the last couple of years. So the acceleration of kind of the market opening up is very extreme right now.
When it comes to a timeline of rollout, what do you expect?
I don't know because I think they have some grace periods and things built in both on the exchange and the broker and the legislative side. So I think there's some things to work out. But I've heard multiple people say that the framework for how this is going to work is already mapped out. So I think from the exchanges side, they have a pretty good understanding of how this is going to work, how the maintenance period, how they're going to handle the auctions, et cetera. And so they think, in the next couple of months, we could have the framework ready to go. And then late into 2026, we are fully trading a 23-hour market.
That is so wild to consider,
Yeah.
especially when you think about, how many playbooks are written off of a traditional trading day, the educational resources. I mean, how much are you going to have to throw out the window now and kind of relearn the game?
Well, the honest answer is we don't really know. I personally think a good chunk. So, for example, the opening range breakout is actually one of the most proven technical signs in 100 years of market action. It's this window from like 9:30 a.m. to 9:45, or some people do it from 9:30 a.m. to 10 a.m., where the market will typically set a range. And then if it breaks out of that range, either to the upside or the downside, it has typically a 60 to 70% probability of dictating which direction that the market's going to go for the rest of the day. 60 to 70% probability wise on an intraday basis is a massive advantage because, baseline stats, 55% of days are bullish or 53% are bullish and 47% are bearish. So you're just a tiny bit better than a coin flip. When you move that up to 60, 65%, you're talking about significant mathematical advantages on just one technical thing that has everything to do with when that opening bell rings that you can probably throw out the window. I mean, we assume that it's going to be a transition period, right? That as soon as the 23-hour market is rolled out, it doesn't mean hedge funds are going to, change up the hours for all of their normal algos and functions on day one, but certainly they're going to take every advantage they can over the course of time. So my expectation is that those kind of time-based advantages will, if not go away, at least shift, but they'll kind of shift gradually with how the participants shift in taking advantage of the 23-hour market. Another fascinating one, which I have multiple strategies based on. So I'm a little nervous and a little excited at the same time, which is just the overnight drift. So the overnight drift, most people don't realize this, is where all the net opportunity comes over the last 30 years in the stock market. People think that from 9:30 a.m. when the bell rings to 4 p.m. when the bell closes, when the bell rings again to close, that's where the market is able to move. The funny thing is, over the last 30 years on the S&P 500, if you owned the stock market every minute between 9:30 and 4 p.m. for 30 years, you basically made no money. The market has actually barely gone up during its quote unquote regular trading hours. All of the real gains cumulatively have happened from 4 p.m. to 9:30 a.m. overnight. And so obviously that's going away in terms of the concentration of that shift, or the way that it's occurring at least is going away. And so for someone like me who's built strategies based on that, I think one, well, this is going to be amazing because during that overnight drift, I'm now going to be able to hit my targets. Whereas right now, if the market's up 1% at midnight, I can't close out of a trade that looks great. I have to wait and hope it doesn't drift back by 9:30 a.m. and blow a trade that would be a winner. On the other hand, I've got to think, well, maybe the advantage just goes away entirely, and now all of the gains are just completely distributed, equally over 23 hours, and we really just don't know. So it's going to be a fascinating transition period once this happens, and I absolutely think that people who are happy to assume that things are just going to work the way they always have are going to be left behind and very confused just a couple months into this situation.
Yeah, I mean, I could totally see that happening. When you talk about algorithms, overnight trading, institutional algorithms have already trade globally. So in this situation, opening it up to really everybody, does that change the game and level the playing field, or just give them more of an edge?
I mean, I think of it as leveling the playing field for sure, but again, there is always two sides to that coin. So, for example, the day trading rule. I think the day trading rule at under 25,000 absolutely levels the playing field for regular people. But it would be dishonest of me to say it's also not, it's also opening the door for tons of people to hand their money over to market makers all the more quickly and more easily. So, like, I do think both things are true at the same time. But fundamentally speaking, Wall Street and institutions, high frequency traders, overnight arbitrage, all of that kind of stuff, we empirically know is very profitable for those institutions. And so if regular traders have the same opportunity, I think that's a positive thing. Yes, it opens the door for retail traders to hand their money over even more quickly, even more aggressively with, 15 more hours of time to lose money during the day. But if you're talking about is the opportunity there for those who execute well, I absolutely think it is. And I think it's a great opportunity. And for anyone who thinks that it's not, like, oh, trading more hours of the day isn't some new great opportunity for me, then I would just ask the question, well, why do institutions do it now when you can't then, if it's not an opportunity to make more money? I think it certainly is. It's just a matter of execution.
So then is there a version here where retail traders win?
I think so. I mean, here's the thing. There's all these stats about retail traders losing money and everything that goes along with it, and they're all true. Because when you take the massive sample sizes, in most cases that tends to be true. However, retail has been doing much better over the last couple of years as they've gotten more freedoms than people realize. People seem to forget already that during the COVID massive collapse and rebound and the tariffs, retail way outperformed hedge funds during those times. They were more aggressive, they bought the dip more aggressively, and they performed really, really well. And so I personally think that there is a huge part of this that's the maturing of retail traders, the understanding, and now getting access to the same kind of tools and opportunities to leverage where I think they are getting smarter already on a level playing field. You're never going to do anything about the large chunk of retail traders who open an account to gamble as if they were just going on a Vegas trip. Okay, they're not getting any advantage because the market's open more hours. And in fact, you could probably argue they're getting a disadvantage. But for the people who are saying, like, I really just want to have the freedom and the capability to trade and execute ideas and opportunities with the same, tools and market hours, et cetera, that institutions do, I think that's a continued progression to the positive for retail traders. And I don't think we're talking about like fairy tale land. I think we've already seen it during COVID, during tariffs, and during some of 2026 as well, by the way, during the recent dip where retail, again, did pretty well.
So when it comes to somebody who's been using the same three tried and true methods up until this point, what are the actionable items? I mean, what are the things they need to look for and change up?
Well, I would say if you're doing something, which I do, that's time based, so it's market structure based, then you have a couple options. Number one, you can close your eyes, keep trading, and hope for the best. I wouldn't recommend that option because I think that the same architecture that builds the timing of the market has major influence on how the market then reacts. In other words, I don't think that the market going up from 9:30 a.m. to 11:30 a.m. 0.5% and then fading and having a net neutral day is now going to have that same behavior when the market changes. I think you can make the argument that the performance will stay in line. I think there's a good argument to be made that overall the S&P performance will stay about the same. I think it'll get a little tick up, but we'll see. I think it'll stay around the same, but I think the behavior will change. And so all of that to say, if you then trade a strategy that says, well, hey, when the market's overextended from 9:30 a.m. to 11:30 a.m., I always short to get it back into this net neutral behavior because 60% of market days finish within 0.25% of the open. If that's your whole strategy, then number one, close your eyes and hope for the best. I wouldn't recommend that one. Number two, scale back, start trading with low size, one contract, kind of test it out, see what's happening under a new environment. You might find that it gets better. You might find that it gets worse. Or number three, just kind of ignore those strategies until that transition period has had the time to develop and use it as an active testing window, which is for the most part what I'm doing. Like, I'll give you one example. The overnight strategy, I'm going to continue trading because I think it's a net advantage. I think the fact that I can hit targets overnight is going to wash out and actually be a net positive advantage compared to maybe some overnight drift that I lose along the way. But like an opening bell breakout strategy, I would probably want to scale back my risk, reassess and see how the market's transitioning before I just kind of keep swinging the bat, hoping that that strategy maintains the exact same structure going forward. So those would be the three. You could ignore it. You could kind of scale back and say like, hey, I'm going to use less risk to confirm that this thing is still working. Or you could just say, hey, I'm going to continue trading all my fundamental strategies or things that have nothing to do with a time basis or a market structure. And all the ones that do, I'm going to hit the pause button on and just see how this market changes over the next 2 months, 4 months, 6 months until I dip my toes back in those waters.
How long do you think it'll take to get back to an equilibrium where everyone's kind of adjusted to it and then you can finally say, "Oh, okay, here is the new like thing that we have to watch," or this, do you know what I'm saying? Like
I mean, I think the real answer is probably years for like the full effect, but I think the first 80% comes pretty quickly. It's like that 80-20 rule. Well, I think that first 80% of people reacting, responding, the big changes in the market will be fairly obvious. And then the last 20% is going to be, I think, over the course of years where like, entire institutions restructure how they do systematic trading. They restructure how they do hours on their trading floor, which some of them already do. But all of those kind of things that takes some time to retrain 1,000 traders on the Goldman Sachs floor to how they're going to do risk management and everything else based on a new market regime is going to take some time. But they're already trading international markets, so that's going to be a lot more condensed than what it would be, for example, you and I getting comfortable with 23 hours, in the regular retail sense.
well, right now so much is headline driven or tweet driven or whatever. Do you think this will downplay that, or do you think it will make it more volatile based on whatever is happening at the moment?
So I think it'll probably downplay it to some extent because we'll have more volume almost every hour of the day. And so when you get shocking news where there's low volume in the market, it has the ability to move the market much further because the way that the market actually moves in practice is that when you get fear or excitement and there's orders being added up, the lighter the liquidity, the faster those orders can rip up or rip down. When there's more volume, it's like swimming through water or swimming through syrup. When there's more volume, it has to chug its way through a lot more volume to make that move. So in general, I think we'll actually see less one-off extreme volatile markets. And then in total, we'll probably see by definition more volatility just in the sense that the market, if it's going to go up 0.5% between 9:30 a.m. and 4 p.m., might go up 0.5%, down 0.5%, up 0.5% 3 times. And now it might do that 8 times to get to the same result over 23 hours. So like cumulative movement, if you look at a 1-minute chart, you will almost certainly see more price changing, more price destinations to get to the same result. But as far as like those one-off pops and drops, I think they'll be reduced to some extent. Now, with Donald Trump in office and everyone else, I mean, how much can we reduce, Emily? I don't know. But I think definitionally, they should be held with volume to a lower extent than how they could, move right now.
In theory, it spreads the hysteria out.
Theoretically, yes. And I think the argument for it going the other way would be more on the retail side, because I don't think institutions, are necessarily reacting outside of like the algos that are doing some of that buying and selling automatically. I don't think most of the institutions are panicking because of a Trump tweet and selling. That happens, but on a regular basis, that's more of a retail thing. So the argument the other way would be that at 9 p.m. right now, when a tweet goes out or something, everyone kind of has 12 hours to digest that. See counter headlines, what happens? Okay, maybe I shouldn't panic so much by the time the bell rings and I can change the position. And now they might just see the thing and react immediately because they can, because the phone's on, the account's on their phone right there. They can sell. So that would be the other like explanation for why it could be more volatile. But I think that's hard to overcome, like the net reality of how much transactional volume is actually going to be in the market at those times, where right now we think of those as lighter volume environments from 5 p.m. to 9:30 the next day.
Well, last question for you. So when it comes to who wins and who loses trading with, a longer trading day, is there a particular kind of trader that this is the best for, and then someone else that it's going to be, it's going to be a tough road?
Yeah, I mean, I think for people who are essentially risk on all the time, more hours in the day is bad. That's what I think. Like if you just want, the honest truth is like if your Schwab account or your Robinhood account is the same as your FanDuel account in your phone, and now you have more hours, I think that's bad. For people who have a systematic approach, and especially in my opinion, where I think we could get a big advantage, and I'm kind of, you can probably tell I'm kind of crossing my fingers that this is true. If you have systematic approaches that are based on targets, and now you have more hours in the day where those targets can be filled, I really think that could be a great advantage. I mean, you look at how some of these stocks move overnight. For example, you buy Apple, you have a 1% target. Very often, Apple moves 1% overnight, but then it's down to 0.25% by the next morning because of the overnight move up and the fade, and then it goes all day the next day and never gets back there. So the trade you made hit your target, but you never had a chance to actually get out of that trade that hit your target. So I think that won't go away. It might even out some, but the fact that the price really did do that, I don't think is going to change a whole lot. And so to me, that I'm hoping that is the biggest advantage, because I love the idea of just more hours in the day to hit my targets. Not more hours to take new trades really, but more hours in the day to hit my targets on the trades that I do take.
Yeah, and I'm excited to hear from our audience too. So if you're watching, please in the comments below, we'd love to hear what your strategies are going to be and how you plan to hear it, how you plan to handle it, because I'm sure there's plenty of people who would like to weigh in on that as well.
Yeah,
Hey,
let us
thank
know if
you.
you're going to be panicking, hitting the sell button at 9 p.m. when the tweet comes out, so that I can plan for volatility accordingly.
Yes, also, we can just have a hive mind, please.
Yeah, exactly.
Well, Nate, thank you so much for your time. I appreciate it.
Yeah, absolutely. Thanks for having me on. And I am really looking forward to maybe having a follow up once this is out and we can see how crazy, how right, how wrong we actually were about how this is going to shape up. Because who knows, how things might develop from here.
Well, this, it popped in my head. So, one last thing. Why isn't this talked about more often? I feel like nobody's really talking about this.
It is fascinating because to me, and again, especially because I have like these overnight trades. So the idea of a 24-hour market is fascinating to me. And I think potentially really beneficial. And I think fundamentally it's just one of the most like structural things we think about the market, the opening bell and the closing bell. To me, this is a way bigger deal than zero DT options or day trading when they first came out. Now, little did I know zero DT options were going to take over the world and be the biggest thing ever. So I was wrong, but to me at the time, I'm thinking like this is so much more fundamental and structural than any of those. Those are just options on a shorter time frame. This is like blowing the whole market structure out of the water. So I don't know. I think maybe it's because trading has gotten so short term. Like, so if you think about it, for investors, this doesn't really matter, right? If you're holding for 10 years, doesn't really matter. And for traders, we really have narrowed the window so short term. Everything matters what's happening tomorrow and the next week. So any event that's, potentially months off, which should be very short term for us, but feels all of a sudden very long term for us, I think just doesn't make it. Like Iranian conflict and inflation, all of that just absolutely dominates because it's so near term that we kind of lose track of things that are coming down the pipeline. And one of the ways that I know this tends to be true on the kind of like narrowed, zoomed in focus is I deal with traders every day. And a lot of times we'll have a situation where the market was on a big rip up like we saw in the most of 2025, like especially through Q3. And then we'll have like a couple days down. So the market will be up like 18% on the year. We'll have like a couple 1% ugly down days. It'll be down 3% from the highs. And people in the chat are saying, oh no, what are we going to do about this bear market? And I'm thinking, guys, it's been 3 red days. The market is massively bullish. But it just always reminds me how zoomed in people are to the here and now and what matters in this moment, dictating everything they think about the market has happened like in the last 48 hours. So I don't know if that's the reason, but that would be my guess, is that we have become shorter and shorter and shorter term focused as traders, that everything that's kind of right out the immediate window seems to get drowned out in the noise.
Yeah. Well, it'll be interesting to see how this rollout happens. Again, Nate, thank you so much. And thanks everybody for watching. Be sure to click like and subscribe and leave a comment for us and how you're going to handle this strategy moving forward.